welcome. You're watching Money 9. I'm Sakshi Batra. Well, legendary investor Warren Buffett had once said, if you don't find a way to make money while you sleep, you will have to work until you die. And this is exactly why you must think of investments. If you're a first time investor, then we're here to help you get started. On this show, we're going to be discussing all about investments and how can you really put your money to work with a very special guest who is joining in. I have with me Mr. Vineet Patawari, CEO and co-founder Stockedge and Elearnmarkets on this edition of Kaise Bachaएं, Kaise Badhaएं. Thank you very much, Mr. Patwari. It's great to have you with us on this platform, and thank you so much for taking out time for us.
Hi, Sakshi. It's my pleasure to be on the show.
Well, thank you. And this is a very interesting topic, and I'm sure it is close to your heart as well because you have been constantly through your platforms also helping millennials to simplify finance and enabling them to begin their financial journey and financial independence journey as well. So, I want to begin by asking you, sir, that for all those investors looking to begin their journey, what are the most important rules that they should know of before they actually begin to invest in any asset?
Sure. So, Sakshi, you rightly pointed out that it has been our motto to educate people towards financial markets, right? And this question of yours is very, very pertinent. The most important aspect is number one, never lose money. All right. So, when you are investing, invest in things where your money can grow. And you know that over a period of time, you will not lose money. So, first rule is never lose money. Second is understand the power of compounding and make it work for you. Uh, Power of compounding is when your money grows and the growth happens, your money earns for you, and the interest or the returns which you earn on your money, that also earns money for you. So it
Okay.
keeps accumulating and it keeps growing. So you have to make the power of compounding work for you. The third and the most forgotten rule is don't put all your eggs in one basket. That
Yeah.
sounds very, very simple. We all have heard that. So basically diversify. Don't put all your risks in one asset class, maybe equity, maybe mutual fund. Just diversify so that you don't lose your money. Again, come back to the first rule. Yeah.
Well, right, sir. Like you pointed out, three very key rules which everybody must remind themselves every time they are going to invest. But I'll just take a cue from where you left last about the asset classes that you spoke about. Now, a lot of millennials we know have got the power to now earn the money, they have the money to spend, to save, and to even invest. But where they usually get stuck is how to begin and where to begin, which are the assets that they need to invest in. So, help us understand for a new beginner, for a first time investor, which are the asset classes that you recommend one should start investing with?
So, we are very fortunate that we are at a juncture where a lot of beginners are coming, a lot of the first timers and the young millennials, and in fact, Gen Z also is entering into the markets, right? So we have a lot of people who don't know much about markets but are entering markets. So I would strongly suggest them that it's awesome that you are starting early. So first thing is start early. Second is start small, because if
Hmm.
you take too much risk at the early stage, then you might lose a lot of money. So start early, start small, and start safe. That's very important. So you can start your investing journey by probably investing in a fixed deposit, then go
Hmm.
to a mutual fund which is fixed income mutual fund, right? These are very safe compared to stock markets. So start safe, and then take your steps forward by investing in, let's say you want to enter into mutual equity markets, you want to start investing in markets. So mutual
Right.
fund is the right route to enter, because someone else is thinking, the fund managers are thinking on your behalf. You don't need to select the stocks. So don't
Yes.
take all the burden on your head from day one. Go slow, take one asset class at a time, and start with fixed deposits, fixed income mutual funds, and then get into equity mutual funds. And last should come the direct participation in equity, where you are selecting the stock and investing in them.
Absolutely. Very important points that one, starting early is key. So, all those new entrants, first of all, you should congratulate yourself that you have entered a sphere where you are thinking about investments, which is extremely important because the earlier you start, the higher you get of the, the benefit of power of compounding, just like how Sir said in the earlier answer as well. But, you also mentioned this very important point, and that is, start safe as well. Start with the safer assets first. So help all our viewers understand, the first time investors, how to understand what is risk tolerance and how can they figure out what their risk tolerance is. How does one decide?
Sure. So, people need to understand that we invest, right? It's not that only our money will always go up. It might fluctuate, it might come down. So, the fluctuation in your investment value, you are willing to withstand, right? You are willing to tolerate. That is called your risk tolerance. If you are willing to tolerate, let's say, your entire money get wiped off which you are investing, you have very very high risk tolerance, and
Hmm.
you can invest in risky asset classes like, let's say, equity investment, right, where you are even, let's say, investing in penny stock or small cap stocks, which are comparatively more riskier compared to, let's say, large cap stocks. So
Yes.
basically, you have to understand yourself, right? And that depends on your age, your investment goals, your income, your comfort level, right? All of that will determine what's your risk tolerance.
Okay. Also, I wanted to understand from you that, nowadays we have seen historically also, it's not just equities were always seen as the riskiest of the asset classes that we have. But now we have emergence of newer asset classes, if we call alternate assets like cryptocurrencies, which are even more risky because they're not regulated. But in the past, we've also seen debt and debt mutual funds, which were considered to be safer, but with the kind of Franklin Templeton kind of episodes that we have seen, even debt investors have had to face some kind of risk there. So for new investors, it is also important to understand how can they minimize the risk when they go ahead and invest, because now we are seeing that everything comes with a risk.
Sure. So, Sakshi, a part of the answer of this question lies in your question itself.
Okay.
See, people need to understand. First point is understand your investments. Whatever you're investing in, you need to first of all go deep into it and understand that particular asset class, right? A fixed income mutual fund did not necessarily mean it's a risk-free asset class. No. In fact, there is nothing called risk-free, right?
Mm.
Even if you invest with the government, there are minutest chances that it might fail, right? Though it's negligible. So obviously, when we invest with some entity which has a chance of going bankrupt or which has a chance of failing, right, we have our assets at risk. This doesn't
Right.
mean that it can be compared to a risky asset class where the
Mm.
fluctuations are on a daily basis. Here, this is a, like Franklin Templeton, it's a black swan event which happens
Yes.
once in a while, right?
Yes.
So the point is, we cannot base our judgment on once in a while kind of scenario. So
Okay.
yes, first thing is understand your investments, whether it is fixed income or whether it is crypto, whether it is
Hmm.
commodity or currency, right? Whatever you are investing in, you need to understand it. What are the risks attached to it? What can go right? What can go wrong? What are the cycles in which it will move? All of that, right?
Hmm.
The second point, which I want to emphasize, is more psychological. You need to understand your own risk tolerance, right? Based on your scenario, based on your psychology. There are some people
Yeah.
who have all the comforts, but they can't tolerate risk. They can't see their money going down. If you are one
Right.
of them, right, then you need to identify that and invest in the right kind of asset class, which should not disturb your peace of mind, right?
Yes.
And the
Okay,
third
that's a
one is,
very well way
yeah,
of actually understanding. That's a wonderful way of understanding. The basics. You just see, how you feel about, when your money goes away. If you lose 100 rupees, if you lose a 2,000 rupees, that will actually tell you how much risk can you actually take. Wonderful take, sir. Yes, please
yeah.
continue.
So, I always say that finance or overall your personal finance, wealth management is more about managing your psychology than
Hmm.
actually managing the money. You have to manage yourself, not the money. The money can grow if you put it one place. But your problem is you keep fluctuating. Your thought process, your psyche keeps changing all the time. So
Yes.
yes. So I was talking about minimizing the risk overall and understanding it. So understand your investments, identify your risk tolerance, and third point, which I want to emphasize on, is diversify your portfolio. As I said
Mhm.
earlier, right? You need to try all the asset classes, right?
Sure.
If one goes fail, if you are doing one in a wrong way, the others will cover you up, right? So at any point of time, don't go overboard on any one asset class. You should
Sure.
have a fair mix of everything, whatever
Mm.
your purse allows, right? For example, if you talk about real estate, you
Yeah.
might not have a venue yet in India where you can invest, let's say, 20,000 rupees in real estate. You can
Hmm.
do that through investing in a real estate company
Mhm.
listed in stock markets. But my point is, you should diversify, right, in whatever way you can.
Right, absolutely. Diversification is key. But I also wanted to go back to what you were talking about financial markets and how we have seen an influx of a huge number of first-time retail investors entering in the market in the last 1.5 years. Of course, the pandemic forced everybody home. There was extra liquidity in the hands of people which they could not spend anywhere, and which is why we also saw so many first-timers entering the stock markets, which is great as well. Over 1.5 crore demat accounts were seen opening in the last 1.5 years. But we come from a background, a culture where a lot of myths are also taking place. When we think about stock market as a place to gamble or making quick buck. So how do you dispel this myth for all these first timers who are looking at the stock market in the current phase, which is seeing galloping growth on an everyday basis? We see these record levels being seen, and the kind of returns the new IPOs are giving in a single day. So this gives them an idea that the stock markets, you can make money in overnight in stock markets, and it is perhaps gambling. So how do you clarify all these things for the new investors who want to enter?
See, I always believe to break any kind of myth, you have to educate people, right?
Yeah.
As simple as that, right? When you are educated, when you are well informed, when you know the basics, right, you can challenge the myths which are created in market, though it's extremely difficult. Let me tell you, when the best of the investors get carried away in a bull market like the one which we are, where we start believing that this will go on for eternity, right?
Yeah.
But obviously no bull market or no bear market can last for eternity. So
Right.
that's very, very important to educate, constantly educate yourself. Number
Hmm.
one. Number two, how we are also trying to help in this is, see, I believe there are four important steps in an investor's journey.
Right.
First is he need to learn, right, about the nitty-gritties of market, about how to read financial statements and so on. The second step is he should have access to the right data, right analytics.
Hmm.
The third one is he should be have access to the right set of experts whom he can consult, just like
Yeah.
we go to a doctor, right? So he can collaborate with respect to his financial wealth. And the fourth one is he should have very good platforms through which he can invest, right?
Hmm.
For example, you said that crypto, it's unregulated. So there is a problem of platform where to go and
Yeah.
invest so that my money is safe. So
Yes.
these four steps, if they play their role properly in this ecosystem, a lot of myths get broken,
Hmm.
right? And the good part is earlier all of this used to be done by a stockbroker. Now there are different players who are taking specialized care of each part. So investors are better off now compared to what they were in the past. So lot of myths which actually get busted in these times. But yes, I sincerely pray God that this bull market should, once this is over, right? And that learning will only happen when this will be over and people will see
Yes.
that cycle, right?
And whether
So
investors will stay put after, even after facing about 50% of a crash in the
yeah.
portfolios, that is
In
when you
fact,
should be. Yeah.
yeah. In fact, we'll also get to know that what happens of these 1.5 crore investors who have
Yeah.
just joined amidst the bull run. So let's see. Let's hope
Absolutely.
for the best. Fingers crossed.
Absolutely. Also, you
Yeah.
talked about investment goals, financial goals. So I wanted to understand, since we are talking about diversification, for all those investors starting off and also looking to diversify in the asset classes that we just spoke about, whether it is going through equity mutual funds by investing or direct stocks or perhaps gold or real estate, like you talked about. How does one link these asset allocations to the financial goals that one may have for themselves in the life course time?
Okay. So, in this, when you want to understand what is the linkage between asset allocation and the financial goals,
Yeah.
see, in my financial planning journey, the first step is to understand what financial goals I have,
Okay.
right? The next one is to understand myself. As I always say, that's a crucial step, anyways. So you need to understand what's your risk appetite, how tolerant you are towards risk, right? So first step is decide your goal. Second one is understand your risk appetite, right? And the third one is to understand the time horizon which I have, right?
Hmm.
So when I want to link asset allocation with my goals, so for short term goals, which are for a particular, let's say I want to buy a car, so my goal
Yeah.
is to buy a car.
Yeah.
I can take moderate risk. That's my risk appetite. And the third one is I want to do it in 3 years. Now
Sure.
think about it. I should have limited equity and more of debt or fixed income, because let's say in 3 years' time, if the
Yeah.
market goes down and my 100% money is invested in stock markets, I invested 5 lakhs now, so and the money went to 3 lakhs, and I need 7 lakh to buy a car, right?
Yes.
So that will not happen because my money is down, and if I cannot get out of that at a bare face, right? I have to keep put, I have to be there.
Right.
So you have to decide the time horizon. In 3 years, you can have a cyclical effect and you might be down in equity investment. So you should put
Sure.
only 20-25% in equity, remaining 70-75% should go in a fixed income security, right? And that can be a mutual fund, that can be something else.
Sure.
So the whole
Sure.
point is, as you asked, the asset allocation always has to happen with all the three things keeping in mind: goals, risk appetite, and your time horizon, the investment horizon.
Absolutely, point well taken. Another thing which most of the investors, get stuck with is to know the right time of exiting an investment. Of course, you have answered that partially in this answer itself that, in case your investments are linked to financial goals, you will know exactly when to exit them. But what if they have just invested for, say, wealth creation purpose, that they want to create wealth? How do they decide what is the right time? See, right now we are seeing the stock markets are at a high, cryptos are at a high, gold is also has been fluctuating, but it did see a lifetime high in the last year as well. But how do we really decide in an individual's course this exact thing?
So if you talk about stock markets, right? If I'm invested in stock market, timing markets is the most difficult thing. You cannot do it. Practically, you
Yeah,
cannot do it, right? As an retail individual investor, you cannot even think of doing it. For
right.
professionals, it's a different thing. Even they go wrong most of the time, right? So timing, don't even try to do that, right? You should invest at all the times, right? And always with your equity investments, remember that there will be ups and downs. So you should have, for any kind of emergencies or exigencies, you should have a separate fund, right? Which
Right.
is in more liquid assets, which is not in stock markets. So you should always have this thing in mind that if I invest in stock market and if I want to get out of it, it might take 2 to 3 years to get out of it,
Sure.
right? That's on a macro level. At a micro level, at a stock level, right? You have invested in something, you are actually making money, and you don't know whether I should exit it or I should stay invested.
Sure.
In that scenario, you should keep track of your investments, right?
Hmm.
And if there is a fundamental change in the underlying stock, you should take it as a red signal and should get out of
Oh,
it. When I say
oh,
fundamental, let's say the management, some other management has taken over and you don't like that management. Let's say the
sure.
management quality has dropped, or there is some corporate governance issue. That's a red flag. Immediately you should get out of it, right? So and let's say over 2 or 3 quarters you have seen that the profits are going down. There can be various, and you need to decide these things. You need to have a set of rules, right? That's difficult, but what you should do is, based on your investment thesis, you should have 4 or 5 or 10 rules, that
Yes.
based on this I'll enter, and based on this I'll exit, right?
Sure.
And the most important one out of that is, in case of equities, your management quality. If that goes
Mhm.
down, the corporate governance problem happens, you should immediately get out of that stock.
Okay. And lastly, I wanted to understand from you for all those investors, like we've been talking about, all through that the new investors have entered this market to make more money, to create a huge amount of wealth, or to get rich. The idea of financial freedom that we have been discussing as a theme throughout this week of Independence Day. I wanted to understand if you start investing early and follow the steps that you have just suggested, is it possible to achieve financial freedom at certain stage of time?
Definitely, definitely. You started the whole show with a wonderful quote from Warren Buffett, right? Which said that your money has to make money for you, and
Yeah,
that's the clear path of freedom from your financial freedom. So what I would suggest on top of that is always top up your investments. That means keep increasing the quantum, the amount of investment which you are putting month on month, right?
that's
And it should grow at a faster pace than your income. Okay,
okay.
so this will make the power of compounding work in your favor, right?
Mm.
The amount is increasing, the time is increasing, and you should remain invested for a long time. Okay, so again, from Warren Buffett, he said that he started investing at the age of 11,
Yeah.
and uh, he said that I'm sad that I was late. I should have invested started even earlier. And this is the power of compounding. After a certain stage, every year your money keeps accumulating, and you will be shocked to see that. Like Einstein said that the eighth wonder of the year, eighth wonder of the world is compounding, right?
Yes.
So, in short, financial freedom is absolutely possible, but not that you do it today and you will achieve it tomorrow. No. Time has to work on your favor, and time is money. Keep investing and remain invested for a long time, and you will see yourself financially free.
That's wonderful. Well, on that note, thank you very much, Mr. Watwari, for these wonderful insights for all our viewers. Most of them are first time investors as well. And I'm sure these are going to be extremely helpful as they begin their journey to financial freedom. Thank you very much. Hope you take care and hope to catch you again on Money 9 very soon. And with that, we wrap up this edition of Kaise Bachaye, Kaise Badhaye for you. But do stay tuned on to Money 9 for a lot of interesting conversations just like this coming up right up.